Good afternoon, and welcome to Forgiveness under the Consolidated Appropriations Act. My name is Dana O'Donnell, Director of Marketing with Schaeferman Lakeland. Attorney Scott Borsak, who is a partner and chair of the Schaeferman Lakeland Business Department, will be presenting today's program. Before we get started, I want to let everyone know that today's webinar is being recorded and will be emailed to you within 24 hours. It will also be available on our website, schaeferman.com. Should you want a copy of the presentation slides, you can download from the Handouts tab. Scott will be taking questions at the end of the presentation, so please submit your questions on the Questions tab, and we will try to get to as many as possible. Let's get started. Scott?
Thanks, Dana, and good afternoon, everybody. Here we are back again, another afternoon. Interesting 24 hours since we last got together, or 36 hours. Today we're here to talk about the changes to the forgiveness part of the Payroll Protection Program with changes that were made by the Consolidated Appropriations Act. Those of you who were with us on Tuesday got a lot of information on applying for a round 2 loan. And as we've gotten so used to in dealing with the SBA, this morning, the SBA posted about 125 pages of interpretation and assistance on the CAA changes that were made to the program. I've gone through 82 pages that were intended to deal with the forgiveness aspect of the program. And mostly what I saw there were changes, sorry, not changes, but merely, excuse me, repetition of interpretation. Apologies. Repetition of materials that were previously released. So not a lot of new scholarship released this morning. There are still plenty of areas that the SBA needs to provide some clarification to. So we're going to have to wait and see what we get in the coming days and weeks. I'm sure there is more coming. As I've done so many times before as we start these programs, remind you that today's program is intended for educational and informational purposes only. Nothing in the program is intended to constitute legal advice or to create an attorney-client relationship. Legal advice can only be provided through a consultation or by engaging a lawyer. So let's dig in. So we have the Paycheck Protection Program started in round 1. Just to backtrack a little bit, it was part of the CARES Act that was passed at the beginning of the pandemic in March of last year. The program initially created a loan to grant allowing for loans of up to $10 million. And if the loan proceeds were spent on eligible expenses, the loan could be forgiven. Initially, the term of the loan was 2 years, and then in changes that were made in the Flexibility Act, which followed the CARES Act, principal repayment was extended to 5 years with a 1% interest rate, and ultimately, as a result of Flexibility Act, the first payment was going to be due no less than 10 months after the loan was originated. There was quite a bit of tussle, if you recall, under the CARES Act about financial necessity. The SBA ultimately assumed that loans under $2 million were going to be necessary, and that loans were aggregated amongst affiliated entities for purposes of meeting this $2 million line. The SBA really hasn't provided any solid guidance on when exactly a loan was necessary. And the SBA announced in May that if they determined that the loan was not financially necessary, but timely repaid, there would be no investigation or prosecution of the borrower for false certification. Now with round two, there is a revenue qualifier built into the legislation. And basically, a borrower can't get a loan unless they can demonstrate a 25% reduction in quarterly gross revenues. So question whether the CAA has given us some explanation on what Congress is looking for in financial necessity, or whether that is a standalone requirement. I'm thinking that the necessity inquiry should be simpler now because all loans are under $2 million, and unless the SBA changes their view that they announced in the course of round one that they're going to assume necessity without investigating it, this ought to put things to bed. And I'll tell you that in the materials that the SBA released this morning, they did specifically cite to pronouncements that came down in round one around this necessity certification, and they cited to them favorably. So the implication there is that generally the SBA is going to assume, I believe, as they did under round one, that if you apply for a loan, sign for the certification, they're not going to look behind that certification, and they're going to assume everything was necessary. So one of the big changes that we got in CAA is what I call the do-it-yourself covered period. Under the CARES Act, a borrower had 8 weeks to spend loan proceeds to qualify for forgiveness, and this has been referred to as the covered period. So the Flexibility Act pushed the covered period to 24 weeks and gave borrowers an election to use a shorter 8-week period. Now, as I've said so many times, what the Flexibility Act did was create this untenable situation for most borrowers. You could pick a 24-week period for forgiveness, and you had to be on the right side of the salary reduction and full-time equivalent, or FTE, tests in order to avoid a penalty, but you had to satisfy those tests for this full 24-week period. You only got loan proceeds to cover basically 10 weeks of payroll, and if your business was truly struggling, I never quite understood how our friends in Washington intended somebody to get through 24 weeks with only 10 weeks of loan proceeds. So CAA addressed these concerns finally, and what the new statute allows borrowers to do is to pick their own covered period. So, for all you home improvement listeners out there, PPP got its own DIY. So what you're allowed to do is start your covered period at loan origination, and you decide when the period ends, anywhere from 8 weeks to 24 weeks following loan origination. You're going to make that election on the application for forgiveness, and yes, we are going to get yet another application for forgiveness because there's more information. And as you'll see in a minute or two, there will be, I think, what would be the 5th application for forgiveness in this kind of one-page, what I'm calling the check the box forgiveness. The other advent that we got in CAA was that the covered period that you select ends the period that you're going to measure against the penalties. And we'll talk about that in a few minutes, but one of the advantages is that if you pick a 10-week or a 12-week or a 13-week covered period, but certainly less than the full 24 weeks that you had under the Flexibility Act, you don't have to maintain salary and you don't have to maintain FTE for the balance of the 24 weeks if you pick the shorter period. So there are real advantages in taking this do-it-yourself covered period and having it tailored to the specifics of your business. CAA has brought in a tale of two borrowers, or quote from Dickens' The Tale of Two Cities. There is a dividing line here, and the dividing line is at loans of $150,000. Those with loans above $150,000, don't pay attention to the next two slides. You're only going to get aggravated. Those with loans under $150,000, the next couple of slides, tailored for you, and not until we get to much later on in the program, there's not very much that you're going to be interested in. Why do I say that? CAA gave those simplified loans a new one-page application that the SBA is working on as we speak. This one-page application asks a borrower to describe the number of employees the borrower was able to retain, estimate the amount spent on payroll costs, and identify the total amount of the loan. Now, what borrowers on these simplified applications for forgiveness will have to attest to is the accuracy of their certifications, that the borrower complied with Section 7A36 of the Small Business Act, and A36 was all the additions made to the Small Business Act by the original PPP in the CARES Act. And we'll talk in a minute why that's so significant. Borrowers have to retain employment records and payroll for 4 years following the loan, and other records that were relevant in determining the amount of the loan they were eligible for and their spending on the loan for 3 years. No other documents need to be submitted on these simplified forgiveness applications, except to potentially prove eligibility for the loan in the first place. That is satisfaction of the 25% reduction test. That's it. One page. Almost check the box forgiveness when you compare to the full-blown process that we're going to be spending a lot of time on today. You don't have to spend very much time to figure out why it is Congress has done this and why the SBA is cheering this. Millions of loans were made by the SBA at $150,000 or less. The burden on lenders to determine whether borrowers are eligible for forgiveness, the burden on the SBA to audit these loans to make sure everything is in order is tremendous. SBA doesn't have the infrastructure, the banks don't have the manpower, so, and frankly, most of the borrowers who got these smaller loans really need them, and they need to focus on trying to get back on their feet, not trying to justify entitlement to forgiveness on their loan. So CAA gives some real relief to borrowers on these smaller loan amounts. Now, I know I know what you're thinking. You've attended a lot of these webinars, and I've spent a lot of time talking about salary reduction and FTE, and how does all of that jibe with this simplified application? Well, we've talked about the FTE penalty, which can reduce forgiveness for a reduction in employee hours. We've talked about a salary reduction penalty, which will reduce the amount of forgiveness based on a dollar-for-dollar reduction in employee salaries of more than 25%. What Congress has done in CAA is to say that for loans under $150,000, the only thing the borrower is certifying to in the application for forgiveness is that they complied with A36, the CARES Act provisions for making the loan in the first place. The penalties, the FTE and salary reduction penalties, are in a different part of the law, a different part of the United States Code. the ability to take the loan is in 15 U.S.C. 636A36. The penalties are in 9005B. So the only thing the borrowers have to certify to are the things entitling them to the loan, not that they pass the FTE and the salary reduction penalty. So since they don't have to certify to the 9005B procedures, I don't believe there are any penalties for loans under $150,000. Now, for those with loans over $150,000, not much has changed. Those under, don't ask, don't tell. That's the way it looks right now. So I think those of you who have begun to amass the information and started crunching some numbers to figure out whether you're entitled to forgiveness and your loan's under 150,000, I think you can put your pencils down. Wait for that new application to come out. Wait for your lender to create another option on their portal and proceed in that way. We'll talk at the end of the program about what you might want to consider doing if you're at 150,000. You're not sure if you are going to get complete forgiveness and you've already submitted your application to your lender. Spoiler alert, shout at your lender, stop working, give me back my application, I'm going to apply again, because you may have an opportunity as a result of CAA that you didn't have when you first submitted. So all of you over 150,000, start paying careful attention, because now this is your time. So for the loans over 150,000, you still have to worry about spending percentages, the 60-40 split between payroll and non-payroll expenses. You still have payroll penalty provisions for salary reductions. You still have to be concerned with adverse changes in full-time equivalents. Again, emphasis on 60% spend on payroll costs. The employee availability exemption, which the Flexibility Act ushered into law, is still out there with a modification. The exemption for an inability to return to business activity as an exception to FTE is still out there with a minor change. Then the due date for the application, you're still looking at 10 months from the end of your covered period, depending on how long you choose your covered period for. So a lot of the same considerations that you had to go through under the CARES Act version continues under the CAA version. Now we're going to pick up the pace a little bit through this, because we've gone through a lot of these points a number of times, and there's a lot more ground that we need to cover in the same period of time. But all of the detail is still available. So the first place I want to start is the workforce headcount, FTEs, full-time equivalents. The law defines them as individuals who work more than 40 hours a week, with 2 or more part-timers whose hours in the aggregate are 40 hours or more. Now, you're not going to get more than 1 FTE once you cross 40 hours, so you're not going to keep aggregating part-timers to try, to get a grouping to create 2 FTEs out of a group of part-timers. Average FTEs employed prior to the loan, because remember, what we're doing is we're comparing FTEs prior to the loan to FTEs during the covered period, and to the extent that you haven't maintained workforce, there's going to be a penalty. The statute gives you 2 periods in which you can select to set your baseline for comparison. It's either the 4.5-month period from February 15th, 2019 to June 30, 2019, or the 2-month period, January 1st, 2020 to February 29th, 2020, I suggest you look to the period that gives you the lowest average number of FTEs, because it's easier to satisfy a lower number during the covered period than it is a higher number, unless you went out and doubled your workforce during the pandemic. You're going to compare your baseline to the FTEs employed during the covered period, and the length of the period is something that you select. In this test, you're going to examine all the employees on payroll during your baseline period as well as during the covered period. If you recall, as to salary reduction, we don't consider individuals whose salaries are over $100,000. FTE doesn't exclude anyone. It's an equal opportunity penalty provider. So we're going to determine the average number of FTEs per month during our baseline period. Again, one period is 2 months, another is 4.5 months. A little hard to massage mathematically an average month out of that. It's been some suggestion that you can make that determination by pay periods in a month. So if you pay your employees weekly, you're looking at 40 hours as an FTE. Bi-weekly is 80, semi-monthly is 87. There is a penalty here for your bad action, and that is a percentage reduction in the amount of forgiveness that you're allowed. And that percentage is going to tie into the percentage reduction in FTEs. You've also heard me talk about a mulligan. You can hire individuals back so that you satisfy your February 15th, 2020 FTE. As I mentioned, you're going to compute the penalty as a fraction. That starts with this reduction fraction. You take the FTEs that you have during the covered period, divide that by the FTEs before the loan, and the penalty, the amount of your eligible expense that you're going to be able to deduct is determined by multiplying that fraction by the amount of the spending that you have for employees on during the loan period, during the covered period. So the FTE penalty is going to apply to the exclusion of the salary reduction penalty where you have existence of both. The SBA has said that where you have both a reduction in FTE and salary as to particular employees, you're only going to take the FTE penalty. But one of the things that CAA did was give the SBA the authority to change some dates in the statute. So, keep your eyes out as to whether any of these dates change. Is the rehiring to February 15th going to change? To the extent we come across any of that information, we'll of course put it in an email to our clients, as well as convene another session here to show you what you need to be concerned about. Now, for purposes of determining the FTE, the number of FTEs, whether it's using a 40-hour work week, you're given two choices. One is to divide the number of hours that an employee worked by 40 and round to the nearest tenth and cap that number at 1. The alternate calculation is to assign all employees who work for 40 or more hours 1, and anyone who works less than 40 hours as a half. And having gone through this quite a bit, I'll tell you that both methods can turn up substantially different results, particularly where you have a number of part-timers who work less than 20 hours a week predominantly, or more than 20 but less than 40. And you have to use the same method. So if you use the actual method, during your baseline period, you have to use the actual method in the covered period. And what more times happens than not is you're going to have to do two calculations. Do it using the actual method and the alternative method and see where you get the better result on percentage reduction in eligible spending. So again, it's important that you consistently apply these methods. I suggested that there was a mulligan in there. For those of you who aren't familiar with the golf reference, a do-over, a chance to fix your FTE reduction. So as a borrower, if you have a reduction in force from February 15th to April 26th, you can undo that RIF and ignore the changes if you rehire some portion of the laid off employees. Now, the advantage of hiring back a specific employee that you furloughed or terminated is that you get credit for both the FTE reduction and the salary reduction. If you hire somebody new without some excuse that we'll talk about, the new hire gets you satisfaction of the FTE, but doesn't get you relief on the salary reduction. CAA changed the mulligan period, so you have until the end of the covered period to hire that person. So if you put them on staff late in the covered period and several weeks later you have to terminate them, you're not being measured adversely by that termination. And you've got a shorter period in which to test. So how many do you rehire? Do you hire to your pre-loan average FTEs or the number that you have on February 15th? The statute says February 15th, and that might be lower than the pre-loan period. Again, I suggest you look at all the numbers to see where your targets are. As I've suggested once or twice before, CAA does give SBA the ability to change testing dates, and I suspect that this rehiring date for the FTE test is something that's going to be subject to a date change later on. I've also mentioned once before that where there's both an FTE and a salary reduction, the FTE test will apply and you won't have to deal with salary reduction. But again, keep in mind that it is on an employee by employee basis. So you have to have the same employee subject to both an FTE and a salary reduction in order to ignore the salary reduction as to that employee. The other test that you've all become very fond of is the salary reduction test for payroll reductions. We're looking at the salary of each employee who's paid no more than $100,000 a year. Anyone who's paid more than $100,000 a year, we push them off to the side. We're going to look to those individuals who were employed in the full calendar quarter before the loan originates, and the salary of each such employee each week during the covered period to see how they differ. And again, this is a granular test. It's employee by employee, not the total payroll across the two periods. Those employees who weren't employed in the full calendar quarter prior to the loan are not going to be tested. And again, we're talking about the first quarter of the loan for the first quarter of 2020, for round one loans. This again is going to be another one of those places where SBA is likely to change a date for round two loans. As I've mentioned once or twice, each employee must be paid 75% of what they were paid during a comparable period prior to the loan. Specific to individual employees, new employees don't help you out on the salary reduction test while they do help you out on the FTE test. And again, that's because salary reduction is personal to the employees. So you're looking at a 13-week period, the 13-week first quarter of 2020 to make your comparison, and a covered period starting at loan origination. So there isn't a simple comparison here, particularly if your covered period is going to be anywhere from 8 to 24 weeks. You're going to have to look at average pay periods within the period of time that you're looking at and make a determination of your average pay period compensation to be able to compare the first quarter of 2020 to the pay periods in your covered period. And to the extent that an employee was paid less than 75%, the amount that you need to get them back up to 75% is going to be a dollar for dollar reduction in the amount of eligible forgiveness. I should point out here, before I go on to the mulligan, that I've been consulted by a number of borrowers who have elected the 24-week period, at least they were electing a 24-week period under the CARES Act. And not surprisingly, their payroll expenses in the 24-week period were in amounts greater than the amount of their loan. And simple math will tell you how you get there. If they get a loan for 10 weeks of payroll, but they pay payroll for 24 weeks, most borrowers are going to have payroll expenses in excess of the loan. So they compute an FTE penalty, and they make a determination of the salary reduction, and they apply those amounts to the payroll they paid during the covered period. And they present me with these calculations and say, look, my payroll over 24 weeks minus the FTE penalty or salary reduction still leaves me with more than enough eligible payroll to cover my loan. I get complete forgiveness. That's not the way it works. The starting point is not the amount of payroll you actually paid. You can think of the starting point as being the lesser of the payroll you actually paid during the covered period or the amount of your loan. So if the payroll you paid over the covered period is greater than the loan, you're going to start at the loan amount. If your payroll was less than the loan, then you're going to start at payroll. So as I mentioned, there's another mulligan here. It's for reductions in salary from February 15th to April 26th of 2020. If you restore the individual's compensation to the rate they enjoyed on February 15th, you eliminate that reduction by increasing their rate, and you do that by December 31st of 2020. Again, this is going to be another date issue that the SBA is going to have to deal with under CAA, because those round 2 loans are going to originate in 21. So the date of restoration is going to have to change. The December 31st dates here, as well as in FTE, are for round 1 loans. Whether the salary reduction is excused or not, you still have to spend the money to get the forgiveness. And here too, as I've just pointed out, the testing dates have to be modified. Excluded employees. One of the areas that caused us the most problem as we were developing responses in round 1 is what to do with employees who resign, who were fired for cause, or voluntarily request to have their hours reduced. And the SBA, in the course of their round 1 pronouncements, have come out and said that those employees who voluntarily separate or voluntarily ask for reduction or whose performance is subpar are taken out of the analysis. So you're not going to be charged for an adverse consequence for an employee who retires, for example. Now, a lot of borrowers put their employees on unemployment, furloughed them early on in the pandemic. And because of the pandemic unemployment insurance provisions in a lot of states, employees were making more money on unemployment than they were from working, and employers had a difficult time bringing their employees back from furlough. So the SBA said you can exclude those employees if the employer offers the employee their job at the same hours and compensation, the offer is made in writing, and the employer advises the employee that their failure to return could jeopardize their state unemployment eligibility. This last requirement was the one that caused most borrowers some heartburn. The borrower had to inform state unemployment Department of Labor that the employee rejected the offer to return within 30 days. The consequence of all of that is that Department of Labor could treat that employee as having abandoned their job, which would effectively take them off of unemployment. They would no longer be eligible. But if an employer as to unemployment followed this recipe, these employees would be excluded from the FTE and the salary reduction tests. The Flexibility Act brought in an employee availability exemption. If an employer borrower experienced a loss of FTEs during the covered period, that loss would be exempt from adverse consideration if the reason the employer had the reduction in FTEs was that he couldn't rehire employees who were employed on February 15th, 2020, and can't hire similarly qualified employees by the end of the covered period. And the making it the end of the covered period was a specific change that CAA made. It used to be by December 31st of 2020, or the inability to return to pre-pandemic levels of business activity due to compliance with government restrictions for sanitation, worker safety, or social distancing by the end of the covered period. And again, that was another December 31st. Either of these have to be established in good faith, but the pre-pandemic level of business activity, I think, is a bit of a head scratcher. I would suggest that because SBA has already said that the FTE penalty takes primacy over the salary reduction penalty, a loss of employee wages and FTE for the same employee for something that's exempted, and the employee availability exemption will exempt the FTE, that the effect of SBA's pronouncement and this provision in the Flexibility Act are to say that if you have an employee, if you have a situation where you've got reduced FTE for either of these grounds, you're not going to be charged for the salary reduction as well. So these provisions from the Flexibility Act are really double grace, if you will. The thing we haven't really seen anything on is further explanation from the SBA as to what they mean by this unable to operate. How, as to gross revenue, how poor the performance has to be to qualify, and what do you have to do to demonstrate that you aren't able to rehire individuals? So you need to make legitimate efforts to hire. you certainly are going to have to place help wanteds, whether it's with Monster or Indeed. Seems like most most hourly jobs today are found online, and that there's no classified ads in most parts of the country for hiring of individuals. So you're going to have to take those efforts to try to locate people to take jobs that you otherwise can't fill. The other part of the exemption here from the Flexibility Act is the inability to return to business level. And the question we haven't seen an answer to as well is, what same level? You're certifying that you were unable to return to the same level as existed before the pandemic. So if you're at 90%, does that work? Do you say that the 75% gross revenue provision in CAA is sufficient? We don't know, because the SBA hasn't given us anything substantial. So if you're claiming these exemptions, you can certainly make the argument that any meaningful reduction is a reduction to the same level. Hopefully we're going to see something from the SBA on this. I haven't seen anything yet. And again, as I've pointed out several times, where you've got both an FTE and a salary reduction for the same employee, only the FTE penalty is going to apply. As a result, the exemption provided by Flexibility and SBA's determination seems to suggest that if you fall into this basket where you either can't hire or complying with health and safety requirements prevents you from operating at the same level, you are essentially excused from both the FTE and the salary reduction penalties. Let's talk a little bit about payroll. And again, my apologies for going through this as quickly as I am, but you see, we still have a lot to do, and we're almost 45 minutes in. So spending on payroll is eligible for forgiveness. Payroll is going to include employee compensation that is salary, wage, commission, paid at an annual rate not in excess of $100,000 a year. That includes cash, tips, and the equivalent. Leave, such as vacation, parental, medical, sick, or family leave, as well as amounts you pay to furloughed employees. What you pay to employees or former employees for separation or dismissal in the nature of severance count as payroll costs. The employer contribution for group health care is a payroll expense. Employer contributions for retirement benefits, and employer contributions to state and local taxes assessed on compensation. An independent contractor or sole proprietor the compensation that they pay themselves is also a payroll cost that is eligible if the independent contractor is the borrower. It includes compensation paid to a partner of an entity taxed as a partnership on income subject to self-employment taxes paid at an annual rate that doesn't exceed $100,000. And as I pointed out a number of times, as developed over the round one analysis, there are significant limits on owner compensation. Sole proprietor partner, shareholder in an S Corp, shareholder in a C Corp are treated differently. The differences lie in health and retirement. The compensation is treated the same. It's basically 2.5 times It's 2.5 over 12 of the average monthly compensation from 2019, subject to a cap. So if the borrower selects an 8-week covered period, the overall cap is $15,385. If the borrower chooses a 24-week cap, a 24-week covered period, the cap on compensation is $20,833. If a borrower chooses something in between, you're going to have to do a proration between those two poles based on the number of weeks. So in addition to the salary, certain business owners can include a portion of health and retirement benefits. You see that for sole proprietors, health and retirement benefits are not considered eligible spend. In an S Corp, any owner with 2% or more or their family members cannot include health. They can include retirement, but it's subject to the salary cap. So retirement benefits and salary for an S Corp shareholder employee is integrated. In the C Corp, the health costs are eligible, no cap, and it's not integrated with the compensation. The retirement costs of a C Corp shareholder are allowed, but again, integrated, subject to the same salary cap. And this tortured chart developed over a period of about 5 months with pronouncements from the SBA. For non-owner employees, the amount of eligible spend for an employee is $15,384 for 8 weeks, $46,154 for 24 weeks, proportionately adjusted. It's basically about $1,938 a week for each employee. There's no apparent limitation on other costs, the health insurance and other benefits. An employer cannot pay an independent contractor with PPP proceeds and claim the payment as an eligible expenditure for payroll. Hazard pay or bonuses are good compensation expenses. Not included in the list is compensation paid to employees outside of the U.S., federal employment taxes, regardless of who pays for them, payments for sick leave and family leave wages credited to the employment under the Families First Coronavirus Relief Act, but amounts paid to employees to secure the employee retention credit are permitted expenditures for purposes of forgiveness. We've got, in addition to payroll, the CARES Act provided for a number of permitted expenditures that you could get forgiveness for. Mortgage interest for loans on business property. You can't prepay interest, and you get no deduction for principal. Rent on leases that were in place before February 15th are eligible. Equipment leases, including cars and trucks, utility expenses, fuel costs to operate vehicles, and fleet maintenance expenses are also eligible. And CAA brought in more expenses that can be considered. So software or cloud computing services supporting business operations, product delivery, payroll, HR, accounting, or expense management are all eligible expenses for forgiveness. Cost of property damage and vandalism due to public disturbances in 2020 not compensated by insurance or otherwise are good expenditures. The cost of goods that are essential to the operation of business or for perishable goods purchased pursuant to contract of purchase orders made before the start of your covered period all eligible expenses, and the costs of adaptations to business activities to comply with health and safety requirements that are issued during the pandemic that include physical barriers, drive-through windows, positive air pressure, ventilation, filtration systems, or personal protective equipment are now all good expenditures for purposes of getting forgiveness. There was a lot of questions during round one about payment dates and incurred dates because the statute talked about expenses that were paid or incurred. The SBA has relaxed all of that. They have allowed payments made after the covered period ends where the obligation was incurred during the covered period. They've allowed payments made during the covered period for expenses incurred before the covered period. So what the SBA has done is changed the phrase in the statute from paid and incurred to made it paid or incurred during the covered period. There's also an alternative covered period that you can use tied to payroll, so you can synchronize the start of your covered period to your payroll cycle. Borrowers with biweekly payroll can elect a period that starts on the first day of the pay period after the loan funds and ends when the covered period ends to coincide with the end of payroll. So you now have this 8 to 24 week window to pick your covered period. If you adopt the alternative payroll covered period, you would end it to coincide with your payroll 8, 10, 12, 14, 16, 18 weeks out, 20 weeks out, as you might choose. If you use the alternative covered payroll period, that becomes your covered period for all purposes, not just for payroll. But I'd suggest that the way SBA is now interpreting paid or incurred, this isn't nearly as important so long as the expense is either paid or incurred during the covered period. Request for forgiveness. So those of you who are in the world of the loans over 150,000, if you haven't already seen this, your lender is going to ask you to make your application through a web portal. There are paper forms to submit an application for forgiveness, but just about every lender that I've seen has basically uploaded that application to their web portal and asks you to populate fields in the portal. What you're going to have to do is provide proof of your full-time equivalents and payroll costs for the pre-loan and post-loan period by submitting your payroll filings to taxing authorities. Many of the payroll service providers have created reports that do a lot of the analysis for you. So you can submit those reports. As far as the other expenses are concerned, you're going to need to prove those that you expended the amounts by canceled checks, bank statements, invoices, leases, utility bills. You're going to be asked to certify that the documents you've submitted are true, accurate, and correct, the same way you do when you file a tax return. You will not be granted forgiveness for loans over $150,000 unless you can document your eligibility for forgiveness. And your lender has got to make a decision within 60 days of the date that you submit your application. There is an SBA sanctioned appeals process. Applications for forgiveness, I'll suggest to you, are due within 10 months of the end of the covered period. I get there because the Flexibility Act says that the first payment for a loan repayment is, if an application for forgiveness is not submitted, is 10 months after the end of the covered period. If you submit an application before that 10-month date, then you don't make your first payment until the SBA considers your application and is itself reimbursed from the SBA on your loan. So you've got 10 months from the end of the covered period. You submit your application. SBA has 60 days to review your application and make a decision. It's another week or so after that when the SBA confirms and reimburses the lender. So you're looking at a little more than a year after the end of the covered period before the first payment might be due. So essentially, you've got 10 months to get this application in, and it's 10 months from the end of the covered period. A couple of tax issues were resolved here. The CARES Act provided that forgiveness of loans would not give rise to taxable income. IRS announced that expenses paid with PPP loan proceeds, which the loans for which were forgiven, could not be deducted from income. So if you got a loan of $100 and you use the $100 to pay payroll, the $100 that you paid in payroll ordinarily would be a deductible expense. Well, what IRS said is, if you get forgiveness for the $100 loan and use the $100 loan to pay your payroll costs, you couldn't get a tax deduction for that. CAA reversed the IRS on the deductibility question. So expenses paid with the proceeds of a forgiven loan are deductible, and loan amounts will not be considered in tax basis of entities that are taxed as partnerships. A lot of those pass-throughs have changes in basis that result from borrowing of the entity as well as payment of certain expenses. So for changes in basis, it's as if these loans didn't exist. I've already gotten a lot of questions about what law applies. If you've completed the forgiveness process and you've gotten a determination from your lender, CARES Act, Flexibility Act apply. No reward here for early submission if you would have been benefited by the changes in the law. If your application is still pending, CAA modifies everything. So if you weren't getting complete forgiveness because you took a 24-week covered period, but what you really needed was a 14-week covered period, and you've got FTE or salary reduction penalties, or you really needed to be able to deduct the costs of PPE, you should be able to get in touch with your lender and say, hold on there, we need to start over. I want to go under CAA for my forgiveness. If you've not applied, CAA modifies everything, so you're in good shape there. Make sure if you've got an application pending and that you would be benefited by a change in the law, that you reach out to your lender and say, hold on, I need to do something else here. And if you're in that category, reaching out to your lender as soon as you jumped off of this webinar wouldn't be too soon. And my apologies to the lenders who suddenly get swamped with telephone calls and emails. I think this is my last slide. A lot of you got EIDL grants. Under the CARES Act, you could get an EIDL grant of $10,000, but that amount was recovered if you got a PPP loan by reducing forgiveness by the amount of the grant. So if you got a $100,000 loan and a $10,000 grant, and you properly spent the $100,000 loan, you put in your forgiveness application, SBA would say, that's great. Because you got the grant and you got a $100,000 loan, you're only eligible for $90,000 of forgiveness. You owe us $10,000. That was the government's way of reclaiming the benefit of the EIDL grant. Well, CAA repeals that recovery. So now EIDL grants coupled with a PPP loan are really grants. In my first example of the 10,000 loan, 100,000, 10,000 grant, 100,000 loan, there would be no repayment, and that borrower would end up with essentially $110,000 without recouping of the grant. I can finally take a breath. I've gotten to the end of this relay race. I know I went fast. My apologies. Dana, I'm sure you've got more questions than I can answer in an hour. So let's see how many questions we can answer now.
Sure. So the first one I have is, are PPP funds used to hire a consultant and purchase equipment to be in virtual offices at employees' homes a forgivable PPP loan expense?
A purchase of equipment wouldn't qualify, but if you lease the equipment lease payments during the covered period would qualify. The amounts paid to certain consultants would qualify. So if you hired a consultant to create a cloud portal that all of your employees could log into to get into the computer network, that would be a good expenditure. If you paid computer services fees to a consultant so that you could do your payroll, process orders, handle all of your accounting online, that would be a good expenditure. So it's, situation by situation, but clearly the information technology business got a significant boost from CAA. I think they're going to be the biggest benefactor of the expanded list of eligible expenses of PPP funds.
If the original PPP loan and the second round CAA loan are both less than $150,000, but added together is more than $150,000, will we be able to complete a simple form?
The forgiveness of round one and round two stand separately. So if you got a round one loan of under 150,000, you are entitled to the simplified process for forgiveness. So for most borrowers, they're going to be eligible for a round two loan unless they have problems with the revenue test, and that loan can be in the same amount as the round one loan. And again, if that's under $150,000, you can get the simplified forgiveness process there as well. So in total, if you had two loans and each loan was 140,000, as I read everything, you should be able to get simplified forgiveness for both loans, even though together they're more than 150,000.
Are there still two mulligans for employees who refuse to return to work and/or have been fired for just cause?
Well, it's not a do-over. You just get to exclude them. So if an employee is fired for cause, we don't have to consider them, but we have to document that they truly were fired for cause. If they don't return to work and they've been out on unemployment, there too, we don't have to count them. But you have to follow those 3 steps, including informing State Department of Labor.
What documentation do you need to prove your revenue has decreased by 25%?
Well, you'll certainly demonstrate what your quarterly revenue was in test period, either 2019 or the preceding 12 months, although I think for most individuals, their 2019 revenue is going to be higher than their revenue in 2020. You're going to demonstrate your 2019 revenue. Best source for that is a tax return. For The current revenue, since you haven't filed the tax return yet, your gross receipts should be able to be demonstrated by the amounts you deposit in your bank. So bank statements for current, and I think tax return for the base year for the comparison.
Is the forgiveness application easy to complete, or do you recommend hiring an attorney or an accountant to help you complete this?
I think it depends on which basket you fall in. If you have a loan of under $150,000, I think you can do that yourself. We haven't seen that application yet, but from all the language in the statute and from some information in SBA's release from this morning, it looks like it's literally going to be check a couple of boxes, initial in a couple of spaces, and sign your name. It will literally be one page. Over 150,000 depends on your circumstance and your abilities. You know, I've worked with a number of borrowers who are able to do it themselves. And I've worked with a number of borrowers who say, tell me the information you need, and can you just give me back a completed application? We've reviewed applications for individuals as well. So it's all a question of what a borrower is comfortable with.
Can you write off the PPP loan on your taxes?
The amount of the loan that's forgiven is not income to the borrower. So taking the loan doesn't generate income. It's not reported. Having the loan forgiven doesn't generate taxable income. So that's not reported either. The expenses that you pay, like payroll and rent and mortgage interest and the cost of PPE, even though you used money from this forgiven loan to pay for those items, is still deductible. So what will happen is, to the extent that you pay these expenses, you'll be able to claim an income tax deduction for them.
Must I submit PPP forgiveness for round 1 before applying for round 2?
No. The application for forgiveness on round 1 isn't due until, at the latest, 10 months after the end of the covered period. So people who've elected 12 or more weeks to their, well, either the 8-week covered, even the 8-week covered period, you still have time on 10 months. And now that you can elect anywhere from 8 to 24 weeks in a covered period, you know, we'll see applications for forgiveness that aren't going to be due until this summer. If you wait to get that application in for forgiveness this summer, there's not going to be any round 2 money left. And I think most of the lenders would be hard pressed to process several million applications for forgiveness at the same time that they're processing what'll likely be several million applications for loans. So the short answer is, get your loan money first, and then get your application for forgiveness for round 1 in, and then ultimately get your round 2 application.
Is there any advantage to apply for round 2 with the same financial institution that you used for round 1?
If you're happy with that institution and they've serviced you well, they know your business, I would go to the same institution.
For loans under 150,000, do you still need to adhere to the 60/40 spend rule?
I don't believe that you do. I can double check that. There's nothing that I've seen in certifications that covers that. The statute specifically asks about a description of the amount or an estimate of the amount that you spent on payroll. But you may not have to. I will double check that. I don't want to say categorically you do not. And I know I said this is a check the box, we're not looking anywhere. I'm leaning towards saying you don't have to worry about 60/40, but I don't want to mislead anyone, and I'm going to double check that.
If we had a PPP loan that will not be 100% forgiven because of FTE and/or salary reductions, can we still apply for PPP round 2?
I believe that you can. You will want to pay careful attention to the amount that you borrow, as well as what your FTE and salary practices are, because you don't want to put yourself in a position where you're getting more money than you can use and leave yourself with an obligation of paying funds back.
Does the info today apply only to the new upcoming loans or for the earlier loans in round 1?
Applies to round 1 as well as round 2. What CAA did was to state that as to the forgiveness and spending issues, the provisions in the statute should be treated as if they were written into the CARES Act when that was passed in March.
Specifically for the forgiveness application, do you have to wait for your bank to accept applications, or can you submit directly to the SBA?
You have to go to your lender. You cannot submit to the SBA. And I know that, some lenders were up and ready to accept applications very early, and other lenders are just now beginning to accept applications. But you have to stay with the lender that you applied through, and that's where your forgiveness application goes.
Can PPP money be used to pay employees more than they were getting before the period of the loan?
Yes, there's no problem with paying employees bonuses, hazard pay, raising their salaries. You just have to stay inside of the salary cap. How about one more question, Dana?
Sure. Since everybody is using this program, I thought this would be a good one to end on. Are Zoom costs included in the software or cloud expense category?
It's a good question. I think it depends how you use it. I think an argument can be made that the cost of Zoom to facilitate HR, production schedules, accounting functions could fit into that category. Yeah, I think what was intended were things like the costs of software or software as a service for handling HR or payroll or remote cloud computing. But I mean, if I could get remote cloud computing in, maybe I can get remote conferencing in. Some really good questions here today, and I will get back to all of you in an email blast on that 60/40 question on the under $150,000 forgiveness. I want to thank everybody for taking time out of their day for joining us today. My expectation is that the next several weeks are going to be kind of busy, and we're going to be doing several webinars. So we'll continue to communicate with the group by email, letting you know what our schedule is going to be. As always, I'm available for questions, for assistance. Many of you have engaged the firm to assist in the process, and we're happy to provide you with the help. You've got my email address and phone number. Much easier to get to me by email than by phone. And we're happy to help you in whatever way we can. Have a good day and stay safe, everybody.